50 years. Half a century. Imagine signing for a mortgage today and still owing the bank when you blow out your 80th birthday candles. What sounds like a pitch for affordable housing could be the blueprint to turn homeowners into renters for life. Stay with me. By the end you'll know who wins, who loses, and one simple question you must ask before you sign. Also, no, you can't pay the mortgage with good vibes. I checked. To really understand how radical a 50-year mortgage would be, we have to rewind, way back, before the 1930s. Because the mortgage system America started with was nothing like the one we know today. Back then, mortgages were brutal. You didn't get 30 years. You didn't get a fixed payment. You didn't even build equity the way you do now. A typical loan was just 3 to 7 years long. Monthly payments were interest only. And then, at the end of the term, came the monster, the balloon payment. One enormous lump sum, often 50% or more of the home's value, due all at once. If you couldn't pay it, you lost the house. No negotiation. No safety net. Just gone. So when the Great Depression hit and unemployment soared, millions of Americans couldn't make that final payment. Foreclosures exploded. Entire neighborhoods collapsed. Banks failed under the weight of unpaid mortgages. It was a national disaster, financial and human. This is where the government stepped in. In 1934, the United States created the FHA, the Federal Housing Administration. And with it came the biggest transformation in American homeownership. The FHA introduced standards that protected both lenders and borrowers. They encouraged long-term, fully amortized loans, loans that actually paid down the principal, not just interest. Then came institutions like Fannie Mae and later Freddie Mac, which built a national secondary mortgage market. Suddenly, banks could lend more safely. Loans became standardized, predictable, affordable. And slowly, the 30-year fixed-rate mortgage became the cornerstone of the American dream. This wasn't an accident. It was designed, very deliberately, to stabilize housing, protect families, and prevent another nationwide collapse in homeownership. And that's how we got here. That's how the 30-year mortgage, something we now take for granted, became the American standard. It wasn't just a financial product, it was a safety net. A tool to help ordinary people build wealth through homeownership. But fast forward to today. We're facing a very different crisis. Not a collapse in home values, but a collapse in affordability. For millions of Americans, owning a home now feels further away than ever. Prices are up. Rates are high. Wages lag behind. And the system built in the 1930s to protect families is being stretched to its limit. Here's what's new, and why this conversation suddenly matters. In the last few months, both the White House and the Federal Housing Finance Agency have signaled they're exploring the idea of a 50-year mortgage. This isn't Reddit rumors or finance bro speculation. FHFA Director Bill Pulte said publicly that the agency is working on the 50-year mortgage, a complete game-changer. And President Trump has acknowledged the idea in his own public remarks. When the nation's housing regulator and the president speak this plainly, it means one thing. This is real policy talk. Real consideration. Real momentum. Because here's the twist no one tells you, a lower monthly payment does not mean a cheaper house. Not even close. Keep watching. Supporters of the 50-year mortgage say this could unlock affordability. Stretch the loan over more years, and, mathematically, your monthly payment drops. Suddenly, more buyers qualify, more people can leave rentals, and more Americans can finally step into ownership. On paper, that sounds like a victory. But remember, that's only the story on the surface. And the surface is the safest place to stand when the truth underneath is shaky. Side note, if affordability were a haircut, this is a Band-Aid. Not a barber. Let's walk through the numbers you won't see in headlines. When analysts compare a 30-year and a 50-year mortgage, the story is consistent. Yes, you do get a smaller monthly payment, often just a few $100s off. Enough to feel like a win, but not enough to change your financial life. But here's the part that does change your financial life. Stretching a mortgage from 30 years to 50 years can mean paying hundreds of thousands more in total interest. Why? Because interest doesn't just keep flowing, it compounds across decades. Imagine two charts side by side. A 30-year mortgage, steady payments, reasonable interest. And a 50-year mortgage, slightly lower monthly cost, but over time, an interest bar that grows and grows until it towers over the screen. Tiny monthly win, massive lifetime cost. And that cost isn't shared equally. So yes, you save a few hundred a month. But you could pay double in interest. Who benefits from that? We'll get there. This is where the real damage happens, not in your monthly budget, but in your future. Building wealth through a home doesn't come from living in it. It comes from paying it off. A 30-year borrower can be mortgage-free in their 50s, right when retirement investing ramps up. From that moment on, their income is free. Their equity grows. And they can pass something forward. But a 50-year borrower? That person could be making mortgage payments well into their late 70s. That means decades of delayed investing. Decades of slower equity. Decades of working longer just to stay afloat. That's not homeownership. That's renting from the bank for a lifetime. Let's be blunt for a moment. A 50-year mortgage sounds like it's designed to help the everyday buyer, but when you dig beneath the sales pitch, the biggest winners aren't families trying to buy their first home. The winners are the industry players. Builders win because more people suddenly qualify, which means they can sell homes faster and at higher prices. Realtors win because rising prices translate directly into higher commissions. Banks win because collecting interest over 50 years is a dream scenario, that's decades of steady profit. And investors win because it opens a new world of long-dated mortgage securities to buy and trade. So while the marketing screams affordability, the math whispers something else. Wall Street and the housing industry walk away with the trophy. So, who loses? First-time buyers who think they're stepping into the American dream, but instead enter a debt commitment that stretches across half their life. Imagine being 25 and still owing a mortgage at 75. That's not a pathway to wealth, that's financial quicksand. Retirees lose, too. Instead of entering their 60s and 70s with a paid-off home and breathing room, they're still writing checks every month at the exact age when income slows down and medical costs rise. And renters lose because when more people qualify artificially, competition spikes. Homes get bid up even higher. Affordability gets pushed even further out of reach. This is how inequality deepens. People who already own keep building equity. People who don't stay trapped on the outside. And here's something most headlines don't mention: a 50-year mortgage can't just appear overnight. There are real legal barriers. Under current rules shaped by laws like Dodd-Frank, Fannie Mae and Freddie Mac, which back most U.S. mortgages, can't simply buy or guarantee loans longer than 30 years without significant regulatory changes. That means for a 50-year mortgage to become widely available, regulators would need to rewrite rules, investors would need to warm up to brand new long-term securities, and Congress or federal agencies would need to approve the shift. In other words, there's a long road between talking about a 50-year mortgage and actually selling one at your local bank. And if you want a preview of how this could go wrong, look at Japan. Decades ago, during its housing boom, some lenders offered ultra-long mortgages, so long that in some cases debt was passed from parent to child. The result wasn't a more affordable housing market. It became a cycle of generational debt and stagnant mobility, buyers stuck in long repayment timelines, unable to build meaningful equity. It's a reminder that extending loans doesn't fix affordability. It just delays it, usually by an entire generation. So what should you do right now? First, don't focus on the monthly payment alone. Always ask, what's my total cost? How much interest will I pay over the full loan? And how long until I actually own this home free and clear? Second, prioritize equity growth. A shorter loan, even 30 or 20 years, builds wealth faster. Third, keep a strong emergency fund. Long loans come with long vulnerability. And finally, support real affordability solutions, more housing supply, zoning changes, and programs designed to help first-time buyers build wealth, not just take on more debt. My take? A 50-year mortgage is a clever cosmetic fix to a deep structural problem. It doesn't solve affordability, it hides it. And it risks turning homeownership into a lifetime payment plan. But this policy fight is far from over, and it's changing fast. Next week, I'll break down how a 50-year mortgage could affect your taxes and what to do if your bank offers one. Make sure you don't miss it. If this helped, hit like and subscribe. It tells YouTube to share this with more people who want honest money information. Drop your questions in the comments. Would you take a 50-year mortgage just to get into a home? I'm answering the best ones in the next video. Thanks for watching, and remember, build wealth. Don't rent it.